Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Juice. It's the event we've all been waiting for. Unfortunately, we have to deal with March Madness as well. But let's not spoil the mood in what's sure to be a festive Fed meeting this week. So what's happening? Well, the Federal Reserve's Open Market Committee meets on Tuesday to start their two-day session that culminates in an interest rate decision on Wednesday at 2 p.m. Eastern Standard Time, followed by a statement. Markets are trying to figure out whether the Fed will raise interest rates by 0.25% or 0.5% this go-around, since the FOMC already indicated they would raise rates at this meeting. They're doing this because inflation is out of control, with prices for everything skyrocketing. Gas has nearly doubled over the past year, and even your dentist probably charges more for the cleaning you don't want to do in the first place. Central banks will raise interest rates to lower the demand for goods and services by increasing the cost to borrow. That incentivizes people to save more and invest less. And as a bit of background, the Fed stepped into, back in 2020 to backstop credit and debt markets as they spiraled out of control from lockdowns. During the Great Recession, the Fed took similar measures over a 2-year period. This time they said they'd hit the ground running in days. That created a bottom in stocks and bonds, sending them on a one-way trip higher until recently. At the same time, the government handed out enormous sums of money to taxpayers and businesses to keep them solvent until the economy recovered. Along with the stock market, the infusion of cash helped lift spending to levels that exceeded those before COVID hit. However, global supply chains never recovered. A shortage of workers, a backlog of orders, containers in the wrong spots, and a host of other issues created log jams at ports and warehouses. Even today, the Port of LA, which historically has no backlog, watches over more than 100 ships moored off its shore. The bottom line is this: markets care deeply about Fed policy. Stocks prefer lower interest rates, but will accept rate increases so long as they don't snuff out economic growth. That's the needle the Fed has to thread, which is being made all the more difficult by the war in Ukraine and the cluster that is the world's supply chains. We can and should expect markets to be volatile after the announcement, but give things a few days, if not a week or two, to digest before coming to any conclusions about where stocks might be headed. That's all we have time for today on The Juice. Click follow and subscribe to The Juice email for your daily dose of market minerals.